Hello and welcome to the Weekend Investing Daily Bite of 17th of December. And the market was smashed down today. Nobody was really expecting this kind of a reaction. Markets went from almost 24,350 down to 24,319. Sorry, 24,650 to 24,319, losing more than 300 points for the day. And this coming on the back of some really good bounces from support recently. So something dramatically changed today? Was it the poor fiscal deficit and trade deficit numbers that came out, or was it the Trump's declaration that he's going to come in and absolutely create a focus towards manufacturing in the U.S. and jobs coming back to U.S. and tariffs on everybody else, tax cuts for companies that will produce in the U.S. Suddenly, after yesterday, a narrative has been created that everything good is going to happen there, and some parts of likely the FII groups have sold uh, in a big way today. We'll come to know of the numbers a bit later than when it's being shot. The emerging markets as a whole, India specifically, precious metals all lost ground today. So it's somewhat signaling that the dollar strength, which is currently the dollar index is near 106.8 or something like that, is likely to go further up. This entire thesis that uh, money is getting concentrated towards the US market. So there is one stat which I've probably mentioned earlier as well, that the US market cap is about 70% of the whole world's market cap, whereas the US GDP is about 25%. So the US is so extended in terms of the market cap. That means that all kinds of funds are flowing towards the US, and US versus the rest of the world is becoming more and more and more expensive. Even the US markets are trading at some 28 times, I believe, somewhat in the range of where Indian market is, or maybe even more expensive than Indian market, when there is more likelihood that India will outgrow on a relative basis. So, but today's fall was so dramatic in the sense that there was hardly any contra move. It just kept going down, 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 down. So we are now at again 24,300 or and nearabouts is that support area where if we break down, then some further crisis will occur. So this recent thesis, and I was looking forward to a, uh, a intermediate uptrend in Nifty probably has been smashed today, although the rest of the market did not smash down as much, and as we will see in the numbers going forward. Today's story is about an IPO. It's a case study. Should you regret having missed this IPO, we will discuss this in the second half of the video. Always, as always, do read the disclaimer fully and do subscribe to the channel if you haven't so far, and click on the bell notification. Markets are back to this breakout 24,300 odd level. This one candle was extremely reassuring that the bottom was done here, but the last two sessions have totally diluted that impact. 1.35% on Nifty, and we are now going to test this support and the average here, and in case we break down, then we are going down further. So 24,300 is where we are, and 23,300 is where we could reach if this really goes bad. Uh, the rest of the market, while Nifty Junior was down 1.32%, the breadth did not seem as bad, especially lower down in mid caps and small caps. Mid caps also down, covering this small gap that we had, 0.66%. Usually, when markets collapse, mid caps and small caps will fall much more than the large caps. But right now, at least till so far, that is not the case. So mid caps down 0.6%, Nifty was down 1.3%, small caps also down 0.56%. So the cut on the larger, smaller part, smaller market cap of the market has not yet happened, at least. And if Nifty continues to bleed like this for a day or two, then of course small cap and mid caps will the back will also break there. So we can potentially wait for some more time, but this is certainly looking like a onslaught of some sort of a sell off by foreigners. Bank Nifty again losing 1.39%. So this entire consolidation that had been happening in this 400-500 point range has been smashed down. So not everything is not yet lost, but definitely it has marred the expectations from the last few days of the market going forward up. Momentum trends advances only 116 versus declines 383. So definitely the bears having an upper hand and the advances taking a back seat. Absolutely red heat map. Reliance down 1.5, Bharti Airtel 2.9, TCS and Infosys 1.9 and 0.56%. You also had HDFC Bank, which has been doing well in the last few days, down 1.3%, State Bank 1.2%, ICICI 1.12%, and you had some relief in ITC, Levers, Tata Motors, and a few other stocks, but most of the stocks of the Nifty got clobbered today. The Nifty Next 50 also, I mean, some shades of green, United Spirits, Lodha, Bajaj Holding, some Adani stocks, Zomato. Uh, but other than that, most stocks also in the deep red. I mean, TVS Motors, Pidilite, almost 3% each. Vedanta, Motherson, Siemens, Chola Finance, Union Bank, all nearly 3% down. DLF also losing yesterday's gain at 2.3%. So there's a sudden sort of attack by the bears, and the market is taking it on the chin. Sectoral trends all red. PSU banks losing 1.8%, infra stocks losing 1.7%, metals, commodities, energy stocks, public sector enterprise stocks, autos, private banks, all losing more than 1.4 to 1.8%. You had FMCG, IT, and pharma, the defensives losing less, although they are also losing, and real estate losing the least. So real estate is really in a relatively strong position versus others. Even on a day like this, real estate managed to uh, drop only 0.1%. These are the PSU banks that dropped. So PSU banks down 1.8%. Bank of India, Union Bank, Indian Bank, Bank of Maharashtra losing the most at 2 to 3.5% right here. The stock spotlight is on Jyoti CNC Automation. So one day gain of 11% and is hitting a new all-time high. In a market like this, showing relative strength, this is something that one should be watching out for. You should be looking for buy on dips on the stocks, because any stock that goes up on a day of bloodshedding is certainly telling you a story that something is cooking there. So let's come to the case study. This case study is about Paytm. Should you regret having missed this IPO? So Paytm shares have now closed above the 1,000 mark recently. Uh, this has been a huge climb from where it had reached at the bottom. But let's recall what happened around the time of the IPO and how big an emotional turmoil it has been for investors in this stock. So this stock uh, listed somewhere near 2,000 rupees in late 2021, and immediately in the first 12 months it collapsed 75%. I mean, that is huge. I mean, for anybody who would have either bought it in the IPO or once it got listed, 75% getting wiped off is huge. And then it made a 128% gain from the bottom in 12 months. But the problem is, once you drop 75%, you need a 300% gain to come back to even. And even with a 128% gain, the stock barely managed to come to near 1,000 rupees, post which it again collapsed for 70%. I mean, these kind of 70% shocks are not easy to take for any investor. And I think in this one, it was Warren Buffett who who really slashed his position and the market really tanked here. And then some barrage of headwinds after the IPO launch. Reserve Bank of India barring the Paytm Payments Bank from new customers, and the business model itself looked very, very shaky. And then expiration of 1 year lock-in, got all the big players and shareholders uh, to sell their stock. Alibaba also, sold to 2 crore shares at 600 rupees. So imagine the one of the core promoters, parent company, uh, selling off the shares at 642 after having gotten listed at near 2,000. That is the kind of pessimism and the downward pressure that was there on the stock. And RBI also regulatory concerns on new users, and uh, essentially a deadlock in terms of going forward with the business plan. And then suddenly from May 2024 onwards, Paytm has done fantastically well from nearly 300 rupees, a staggering 235% rally in 8 months, and it is now back nearly above 1,000 rupees. So if we see its chart, there have been 4 phases of the Paytm stock, and this kind of a move can be very, very tough emotionally for any investor to play. I mean, initially getting broken down from, let's say, 100 rupees to 25, and then going from 25 to, let's say, 55, 60, and then from 60 again you are getting reduced to maybe 20, and then from 20 to go to 65, 70 again. So this is the kind of move that can really put somebody into a situation where uh, you may have averaged down, and then you thought it was going up, and then when it collapsed you panicked and you sold off here, and then once it is now crossing its previous pivots, maybe that's where people are buying. So all the decision making can go for a toss with this kind of a volatility. Now the momentum perspective here is that in these 4 categories of play that happened, no momentum strategy would have picked the Paytm stock here. In this rise, yes, some momentum strategies would have picked it, but in this fall, again, there would have been an exit, and you would have made some money in this rise once again. So essentially, your capital would have been prevented from getting eroded. Even if you did not make any money in this entire period till here, you would not have lost money as well. So that is the key part of momentum investing, is unless you are able to save your capital when the stocks are going like this, you will not be able to build it back also. Just like that example, that if you go deep into a uh, a, 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 a drawdown, it is very, very difficult to come back from it. So you need to have your losses small and your gains should be very big. So any momentum strategy may have picked this stock here, but then may have immediately gotten out, maybe 7% loss here. Another one could have been a picked here near 700 rupee odd and currently running at 35. So you would have had only maybe a couple of trades in this entire almost 3-year period, and not made any huge losses on this stock. So this is how you sort of emotionally, it would be very, very easy for you to deal with this kind of a situation. And in general also, when you look at IPOs, what is an IPO? Is an exit for some people, and some other people are entering. Who is exiting? Exiting folks are the smart guys, the private equity investors, the promoters. So they want to maximize their exit price. Obviously, I mean, anybody would want to do that. So and usually these IPOs will come when the market is full of greed, and people are willing to buy at blindly anything that comes on the radar with the branding, and that's where retail gets sucked in, and they will buy it at prices which are not sustainable. And then the hype is created that you're not able to get subscriptions, so you're applying from 10 accounts, and you're wanting that subscription at any cost. And then the eventuality happens that the stock falls on its place. So this flipping game that is happening in IPO is very, very highly risky, dangerous game. On the side, if you want to set aside 10% to do this, that's fine. But if your main game is doing this, then some of the IPOs you will come across are going to take away the carpet under your feet. So this position size and leverage is to be controlled. If you are borrowing money to do this in HNI category, etc., be very, very careful of doing this in the IPO business, because remember that you are against the seller, who is likely to be a smarter fellow in terms of knowledge about what exactly is the value of this particular IPO. So do mention in the comments what has been your experience with Paytm so far. How have you invested? Have you sold it off? And how do you play such highly volatile stocks in your portfolio? That's all I have for today. Thank you so much for watching, and do like and share this video with your friends and family, and do subscribe to the channel. Thanks. Bye.